Let's focus on market and the economy. And Kashyap Pujara is joining us now from Axis. Kashyap has done a very exhaustive research, traveled with his team across the country to assess what extent is the economy suffering in terms of slowdown, what sectors are getting impacted in what manner, and he's here to talk to us more about that. Kashyap, good afternoon. Thank you very much for your time. Which all places do you visited? How many companies on ground did you visit? And tell us a little bit about the on-ground research which you have conducted.
Yeah, so our team visited close to 33 cities in 18 states of the country, and we met close to 150 dealer distributors across each of these cities, mainly focused on key categories like auto, FMCG, building materials, consumer durables. So that was the kind of breadth we cross-checked with, and this was mainly to assess the extent of the slowdown and pessimism that is prevailing in the market, as far as the economic slowdown is concerned, as to what is the real finding on the ground. And I think it was corroborated that, from these dealer distributors, when most of them kind of said that yes, the business has slowed down. Almost 60 or 65% of the respondents kind of claimed that the business has slowed down. Most of them were undecided or not willing to invest going forward. And in certain pockets we saw, I would say in quite a few pockets we saw increase in the working capital levels of these dealer distributors. So clearly channel hygiene is also kind of suffering in terms of tightness and slower growth on the ground. So we are clearly seeing some of these signs at the ground level.
Right. Kashyap, what is your sense of how much inventory is still there in the system? Has it got cleaned or not across categories? How much more slowdown can we see after the initiative which are taken from the government? Various companies are going ahead, cutting their rates in terms of, lenders are cutting their rates, companies are giving deep discounts. You've seen cycles before. How long do you think this one will last?
So let me give you key differentiators from this yatra that we had. I think the key finding that we got out from this visit was that the extent of slowdown in the auto space was far severe across the geographies and across all product categories that we would have envisaged sitting from Mumbai. So I think clearly there is a dramatic slowdown there, and I will not be surprised with further cuts to the consensus estimates from where they are at the current point in time. Also on the FMCG companies, what we witnessed was that the slowdown on the retail sales is far starker compared to what we would witness from the company's primary sales standpoint, which means that more inventory has been pushed onto the dealers, but dealers have not been able to liquidate some of those inventory. So maybe a reading on FMCG companies' reported top line might not be a real barometer of what actual sales have happened on the ground. Also, we are seeing signs of channel deterioration where there is a structural issue dealers are citing, distributors are citing, saying that their traditional distribution model is under threat because increasingly retailers are directly reaching out to modern retail, the cash and carry, and cash and carry is able to give them heavy discounts, higher credit terms, and even doorstep servicing. So that is kind of putting the distribution model of traditional India under a question mark from a longer term standpoint. I think that apart, you raised a very valid point about inventory, and I think while we have seen corporate tax rates getting cut, and we are kind of building in that over time this will lead to a investment uptick because more money is now left with the corporates to kind of invest. But the key issue about this demand slowdown that India Inc. is facing is inventory. So unless inventory is really cleared from the system across maybe auto or maybe housing, only then can you see utilization levels moving up, and if in fact corporates then kind of getting incentivized to do the capex spending. And I think inventory can be cleared only through either prices come down and demand comes up and you get a clearance of the inventory, or the income levels and move up, job creation pace improves, and you see the demand acceleration and inventory getting cleared. I think given the context where we are in, direct stimulus to the consumers to kind of consume would be very essential to get the inventory cleared. And I think in a sense, whatever we are speaking of, I mean whatever the news that are being picked up from the media as far as the personal tax cuts which could be on the annual would be a step in the right direction if it were to come through.
Sense from how should investors for the next, say, 1 year plus kind of a view have defenses like IT and pharma in their portfolios? The regulatory issues for the Indian pharma are just not getting over. IT, which was standing tall so far, is also showing signs of slowdown. That's it. That's what TCS commentary is showing. What are your thoughts on these two?
So I think if you look at the pharma space, at one point the pharma space contribution to overall market cap was in double digits, and that's come down to low single digits at the current point in time. And that's obviously because of the regulatory issues or the US FDA issues we've faced. So I would not kind of double count at this point. I think the cycle is weak and that cycle is kind of priced in. I think what we would basically look at is companies where there is a strong domestic business or maybe strong domestic business coupled with export business. And in many cases, we are finding that the valuations for the domestic business is kind of, corresponding to the total market cap at which the company is trading at today. And the entire export business more or less becomes like an optionality at the current point in time. So if one has a 2 to 3 year view, and if the company, has a strong management team, I think that some of these opportunities in pharma are really worth looking at the current point in time, while the sector is currently under pressure. So maybe there will be a couple of quarters for which the of pain still left in some of those prominent names where earnings might still not really show up. But I think the stocks from a valuation standpoint could have bottomed, and maybe this is the right time to start exploring to increase weightage in the pharma space. As far as IT is concerned, both revenue and margins seem to be under pressure, while deal wins seem to remain strong, is what I could make of from the bellwether results which came out today. And I think going forward, from an expectation of growth on the space, it's going to be in single-digit earnings CAGR. So it could be a defensive hideout at best, but not something which we would really recommend to be overweight on. So IT would again be underweight. I think to address your larger question of exports, like what you mentioned, one thing you need to kind of keep in mind is that exports is largely a function of global demand. And if you look at global demand, it's clearly been weak. And this is despite 10 years of quantitative easing that we have seen the globe at. And despite tax cuts and quantitative easing, we've not seen globally investment rates across countries move up. And that's also been because China is the mother of all capacities. Until those capacities are not clearly utilized, no one globally seems to be in a mood to actually go out and spend and set up capacities. So, and the similar thing is kind of taking a connection to what India is going through. I think while we have seen corporate tax cuts, and over time one should expect investment uptick going forward. But clearly right now the need of the hour is to kind of stimulate domestic demand, and a direct stimulant is what would be required to kind of put the economy and the virtuous cycle back on track. But from a perspective of GDP growth, our sense is that currently we are at the bottom, and maybe in the next couple of quarters we would surely see the GDP growth print start looking far better than what it is now. So the real economy might take a couple of quarters to kind of show an uptick, but from a market sentiment and equity market investing outlook perspective, I think from a 2 to 3 year perspective, we are quite optimistic on the way we see markets.
Thank you so much for coming over today. I look forward to getting more, chatting up with you a little more often from here on. Thank you very much for your time and great detailed research on that Yatra report which you guys have done.